a little sample, and if I filter too little, I'll have too big of a sample. So what I basically try to look for are things that are just a little bit above average, but I make sure that I'm paired. I make sure that strong initial trend is paired with strong breakout. Those are my two keys. And also I make sure that I'm looking at these non-trending patterns more specifically. And again, that's my personal preference. I like to trade breakouts of non-trending patterns. So those are my personal preferences. Now, in order to trade successfully, that you're always going to have to use a stop, and that's because when you have stops and you use stops, you're protecting yourself for another day. You know, if you end up with too many trades or too many big losses, then you're doing something wrong, and that is you're not holding on to a trade, or you're holding on to a trade too long, or you're not using a stop. And what I suggest is when you use your stops, always try to find the stop first and then back into the entry. I think as a professional, I learned to do that as opposed to what the public tends to do, and that is they find their entry first and then they find their stop. You can see that from reading and watching many of these markets, you'll notice that there's 100 different ways to get in the market, but usually when it's time to get out, all the different systems converge into one exit, and that's the reason why these rallies take long to develop. But when the market's ready to turn down, it seems like everybody's running for the door. It's almost like somebody yelled fire and everybody ran for the door. And again, the reason is because more people spend time entering the market than they do exiting. When they exit, it's basically a decision they make right on the spot, and it tends to be a reaction to an event. Now, I'm going to show you some examples of when you use these triggers. When you use a trigger, you can take a breakout through a predetermined price level. In other words, you can see this pattern setting up, and when you get to this point here, this candlestick, you can say, I'm going to sell this when it breaks a particular level. So you can have a predetermined level that you're going to sell at. The other way is an anticipation way, and that's using stop entry, and that's following an emerging pattern. So when you get an emerging pattern, like for example up here, this is where it's all green and red. This is what it looks like before the market begins to form its breakout, and this is what it looks like after the breakout. It's white. So what you can say is that when you start to see an emerging pattern form after this market, say, makes this top, auto chartists will say, okay, it looks like we're developing a break to the downside. You can anticipate that it's going to break out by entering early with a stop and then play for a breakthrough support and resistance line. No one says that you have to wait for exactly this break here of this line before going short, but once you see a pattern developing, or auto chartist defines it as an emerging pattern, and you know that you have an exit up here, you can select any one of these prices to get short on, knowing that that's your exit. If it goes through that, your pattern's negated. So then you can get in ahead of time. So one way to trade it is to anticipate it. All right. Another way to trade it is to sell, use a sell stop under support. So when you start to see this break taking place, auto chartists will identify, once you have this top in, auto chartists will say, well, that's an emerging pattern. So once you know that a break through this support is going to make it a completed pattern, you can put a stop under this line to stop yourself in, and that's a momentum trader does. He tries to stop himself in the market to take advantage of a quick move, as opposed to the swing trader who tries to sell up here in anticipation of a move. So that's the difference between the two. But those are two ways to enter. Now you can also use what we call a close over method, and that's where you wait for confirmation of the completed pattern. And in this case, you get the breakout pattern, but you wait for this candlestick to close over the resistance line. So instead of trading the momentum through the line, wait for it to close over it, and then pick up the trade on the second candlestick looking for the target price. Okay, that's another way to trade it. It's for a more conservative trader who wants to have that confirmation. You know, he wants to wait for the market to make a definite move. So that's one way to look at it. Another one is to follow through. You want to have that follow through soon after the breakout. So you can see here in this case, you had a 4-bar breakout. This market went through the resistance line, but there was no pickup in momentum, and the market pulled back down. Okay, so to be a trader, when you see this pattern developing, again, if you're trading momentum and you see the momentum stop, you're out. But if you're one of those traders who wants to wait for that close and he didn't get it, then he's got a chance to wait or maybe pass on the trade. One clue that you want to look at when you're dealing with these failures is that if they do happen, they often happen with a channel pattern. And that's because the distance between this support and resistance is fairly large sometimes. And so by the time it gets up to this breakout here the first time, it's already made a substantial pattern. With triangles, on the other hand, it compresses so much that traders are just waiting for it to move and they're ready to pounce on it. So when you're dealing with a channel pattern that has a wide distance between support and resistance, you want to make sure that you have a solid breakout. The other thing is you can see initial trend was high and breakout was weak. As I said before, if you can get a breakout and initial trend trading pretty much equal, 6 bars or more, something where there's uniformity between the two, you tend to get better patterns also. All right, moving on quickly now to another zone here. This is no follow through again. You can see a big spike. The market hit a small target here. This wasn't very much of a chance on this particular trade, but auto chartists identified it quickly, and you can see that those markets adhered to it pretty much and didn't move up. So when you get patterns, you want to make sure that you have solid risk reward. If the target zone is too tight for your liking, then you just pass on the trade and move on. All right. Here's where you had a close under resistance. You can see here's where the market went under and then closed back above. But here's where you had that second close under it, and then you had that extension down. So those happen too, that you want to watch how the market's closed and you want to have your follow through. So those are all these different kinds of triggers you can look at. So you can also have this retest and confirmation. So here's where the market broke through and then rallied back and retested and then picked up the trend again. So you can see there's different ways to trigger the market. So if we were going to recap some of these triggers, as one of the key questions today is, if you want to name the 3 trigger methods, number 1, you could sell on a stop, okay? Number 2, you can sell after a close under a support line or buy over after a close over resistance. And the third way is you can let the market confirm and then try to sell a retracement back or buy a retracement back. So those are the 3 ways. Enter on a stop, and what you're saying is you're a high momentum trader and you're aggressive. Wait for the market to go through, close below it for an hour or for a bar or so, and then take the pattern. That's more of a conservative approach. Both of them have good risk-reward ratios, and that's all set up by the target and by the momentum. So again, decide what type of trader you are, aggressive with stops or conservative by waiting for consecutive closes. Now, another part of trading is the exits. Okay, when you deal with TradeStation and the exits, you want to deal with fixed points. Okay, you can set a fixed point, meaning that if a market, for example, you get a buy signal on a breakout, you can say, if the market goes back under this price, I'm out. I don't want any part of it. You can set a specific dollar amount. So depending on the size that you're trading, you can say, if the market goes against me a certain amount of money, I want to get out. Okay, And you can use these 3 key areas that AutoChartist developed called Power Stats. And Power Stats has a range, a price range forecast. It has a movement per hour forecast, and it has a movement per day forecast. So I'll show you a few examples, then we'll go live. When you're going to exit, you could set a target zone at the AutoChartist forecast zone. That's that gray box. You can set a Power Stats forecast zone, which I'll get to in a minute. Or you can set your own defined target zone. That could be a retracement. If you're working with the MT4 program, you could certainly set up some kind of trend line retracement. You could set up a 50% retracement. You could set lines at old tops and bottoms. And you can combine them with AutoChartist forecast zone and its Power Stats. And all those could be set up as your target zones. Okay, so here's an example. When you set a minimum target zone, you can see sometimes the market will reach the top of the target zone, and that's your minimum target zone. Okay, and you have to learn how to read this, that if a market does hit the target zone, that immediately should send a warning to you that maybe you should trail your stop so that you're not exposing yourself to 100% give back of the entire break. So one thing you may want to do when you're developing your system is that you say, if the market hits the target zone, the initial target zone, I'm going to move my stop to break even, or I'm going to move my stop to lock in 50% of my money. Okay, so that's one thing that you can do when you develop your system, is set your rules for when the market hits a target zone. Other times you can see that you hit the target zone like you did here, but then you hit somewhere in the middle of it. Okay, in this case, if you enter the target zone, then what you may want to do as you're trailing your stop, you may want to say, if the market goes back above my target zone, my initial target zone, then I want out. In all cases, anytime you hit this target zone, doesn't necessarily mean you have to take off the whole position, but what it can mean is that it's a call to action. You should either trail your stop or at least to break even, and then trail your stop to lock in some profits also. So it's very important that you have these targets in mind, or these rules in mind, when you hit target zones. Okay, now, as I mentioned earlier, here's an example of this expected price range from AutoChartist. When you go to Power Stats, and I'll show you live here in a second, you'll see that as this section pops up, it's going to tell you the expected price range. It's going to tell you the vehicle that you're trading, in this case the Aussie 200 CFD, index CFD, and it's going to tell you the time and the date. It's also going to say that on a 15-minute basis, 30-minute, all the way up to daily, what the expected range is. And what this indicator's been developed over time using historical volatility data. So it's pretty good indication of where the market can go. So when you are trading, not only do you have the ability to have that target zone, or that gray box from AutoChartist, but you also have the ability to set these parameters as additional points. So what I try to do is, if I'm using a 1-hour chart and I have a target zone set up, I look to see where AutoChartist has its target zone. Is it below my minimum? Is it in the middle? Is it over it? I try to look for overlap so that I can get confidence that, hey, this isn't a bad price I picked. I think I can get there because AutoChartist has two indicators, independent indicators, picking the same price. So it's very important that I try to coordinate those two. The same thing when I'm picking my stops. I want to make sure that if I'm saying the market goes through this level, that I want out of this trade, I want to make sure that I'm not exiting right at a point that AutoChartist claims it can go to, because otherwise what happens is I'll just be stopped out on a low. So I want to make sure that if this is considered the norm, I want to make sure my stops are outside of that norm so that I'm not caught in a whipsaw market. So that's why this is very important. So when you are working with trailing stops, as I said, you need to have a trigger. You hit that target zone, you need to trail your stop. And you can use Power Stats as your target to set your trailing stop. You can set a fixed level You can say also that when the pattern fails, you want out.